The Hong Kong Institute of Chartered Secretaries recently held its 10th biennial Corporate Governance Conference in Hong Kong. In the following presentation from that conference, Ms. Pru Bennett, head of BlackRock Investment Stewardship, explores the role of passive investors, such as BlackRock Investment, in the governance of companies in Hong Kong. Ms. Bennett focuses on the stewardship and fiduciary duties of institutional shareholders.
Well, thank you very much for asking me to speak with you today. It's a real pleasure to be at such a very high-quality conference. So my name's Pru Bennett and I head up what's called BlackRock Investment Stewardship. And I'm just going to touch on a couple of things, which will be just who BlackRock is, to put what I'm saying into context. Voting at BlackRock, it's a function that we take very seriously. How we deliver our stewardship function to our clients, why engagement is key, and just finish with looking at some of the key voting issues in Hong Kong. So BlackRock is the world's largest asset manager with around $4.9 trillion under management, and I have to confess that is still a figure that I'm trying to get my head around, even though I've been with BlackRock for over 6 years. But if you look at the pie chart on the right, what that does show you is that $2.2 trillion of that is in passive equity. Because we're such a large passive manager, and this applies to a lot of our investments in Hong Kong, selling is not an option. So we are a long-term shareholder in your companies, and we're often aligned with the family-controlled companies because they too are long-term shareholders. In Hong Kong, we also have other styles of investment such as active and quant, but we are predominantly a passive manager in this market. Now, that doesn't mean we're passive when it comes to voting and engagement, and I would actually refer to BlackRock as being an active investor as opposed to activist. So why do we vote? Particularly if we're passive and we can't sell, well, we have two opportunities. We can vote and we engage. And one of the reasons that we vote is that we've got a fiduciary duty to our clients. And BlackRock only manages other people's funds. We're not managing our own funds, so we have this fiduciary duty to our clients and this stewardship function for the companies that we're invested in. And where concerns are identified during the voting season, we will enter into private dialogue with companies, generally around getting clarification of the issues. We do try to attempt that when we are considering voting against any proposal, to engage with a company before executing the vote. And often we'll get more clarification around the issue, and what we try to do is develop that relationship with the company and support the company through that change, and that may just be as simple as more disclosure around the issue, or it may be around not putting a particular proposal on the AGM agenda. And voting really is the broadest form of company engagement. As a long-term investor, as I said, we are keen to build constructive relationships with the companies in which we're invested. So I can summarise the stewardship function that we carry out, and we are very much supporters of the recently released stewardship principles in Hong Kong by analysing, engaging, voting and participating. So what we do is we analyse companies from an ESG perspective, that's environmental, social and governance. Now, it's very unfortunate the way that term developed in the early 2000s, having G at the end, because we definitely see G as in corporate governance being the most important component of ESG. We look at E&S issues through the G lens. So if you get the board right with competent directors who understand the company and provide strong and independent oversight of management, we believe that board will understand the exposure to and management of environmental and social issues of the company. So the G really is more important, and that's where we focus, even though the acronym has G at the end. We engage with management or board members on corporate governance issues, including environmental and social issues. On governance issues, we try and engage at board level, particularly with the chairman. In Hong Kong, sometimes we only get as far as investor relations or executive management. But I am seeing that. I have been here for nearly 3 years, and I think there's a definite change in culture and attitude towards company engagement with key institutional shareholders in this market. As I mentioned before, we try and vote at all meetings. And lastly, participating. We feel that we have an obligation and a duty to participate in regulatory debate. There have been a number of issues in Hong Kong where we have participated in. One was on weighted voting rights. We did a response for that, and also for the principles of responsible investment. And we will be providing a response to the current consultation paper with HKX and SFC. So the key to engagement from a corporate side is really knowing who you're engaging with and who are your investors. If you think of the earlier slide that I showed, you could see that a big percentage of BlackRock's holdings are passive. There are other managers in this market that are purely active, so they can vote with their feet. We can't. There are other managers that might have a quant style. So it's not just important to know who your investors are, but what their investment style is, because that will impact the way that you engage with them. I think it's important to get the message back to your boards that it is important, particularly for the chairman, to engage with key institutional shareholders and know them and build that relationship, and not wait until there's a crisis or a major related party transaction to be voted upon by shareholders to reach out to those key shareholders. Always take back the feedback from engagement and use that to improve disclosures. And this will also have positive impacts, particularly as when you see proxy advisors reviewing your practices and your notices of meeting and advising institutional investors how they should vote. It's really important in your disclosures to actually tell the story. I mean, I can give an example where we were looking at a meeting. The issue to be voted on was a significant dilution to shareholders. Both proxy advisors were recommending voting against. We met with the chairman and said, can you tell us the process the board went through to decide that this was the best way to raise capital? And he did, and it made logical sense. But when you looked at the explanatory memorandum, that information wasn't there. And so I think companies need to think about shareholders to tell them the story, particularly when it comes to supporting voting issues, so that we understand why we should be supporting this. A lot of information memoranda meets all compliance issues. I'm not saying that anything doesn't comply with regulation, but often it just fails to tell shareholders why they should support the particular proposal. And as I mentioned before, plan your engagement early. Don't wait until after the meeting materials go out. You can have discussions around corporate governance issues and structural issues which won't breach continuous disclosure rules. And just lastly, key voting issues in Hong Kong. Election of directors, we have to vote on that at every AGM. We go to the annual report to see who's up for re-election, and often we're just told their name, age, current and former directorships. We'd like to know what background they have, what skill set they bring to the board, are they appropriate to the board? So more information around the directors to make our voting decision much easier. Other issues, we see a long tenure which often isn't explained. We see lack of board diversity and quite perfunctory disclosure when it comes to diversity policies. We don't understand where the accountability for the policy lies. We can see that the company has a policy, but who's accountable for it? Is there any measurement? The general mandate is an issue that we engage a lot on. Often we see the general mandate asking for the 20%, we'll see the 10% buyback and the reissuance as well. And we'll look at the balance sheet and it's full of cash. We'll say to the company, why have you asking us to support this? Oh, because it's been on our agenda for the last 20 years. That's not a rationale for shareholders to support that. And we have seen the general mandate used in a way that is not in the interest of all shareholders. So we are quite happy to support it, but we want to see disclosure around why we should be supporting it, particularly if there's a significant amount of cash on the balance sheet. The fact that you want flexibility, we do understand that, but often, as I said, looking back at gearing ratios, etc., it's just not needed, and we have concerns about how it might be used. But if there is a cogent explanation for shareholders to support such a transaction, then please put it into your explanatory memorandum. Another response I got around the general mandate was, our lawyers told us to put it on the AGM agenda. And again, I explained to him why we had concerns. The particular director agreed with us. We actually supported that because we thought it was low risk that it would be used, and we believe that it won't be on the agenda for next year unless absolutely necessary. Around audit issues, we still see a lack of disclosure, and again, this is an issue that we engage on around non-audit fees and better disclosure around non-audit fees. Non-audit fees can impair the independence of the external audit, and if there's a strong case for having a significant amount of non-audit fees, and I have seen certainly some good examples of where that can be supported, please explain that to your shareholders. And just lastly, on related party transactions, and I guess that's when a shareholder like BlackRock becomes very important to you because the major shareholder can't vote. The process that the board has gone through to conclude that shareholders should vote on this transaction is often missing from explanatory memorandum. So again, we have to reach out to the company and ask for greater explanation. And it's important that information is in the public domain because of the third-party service providers that are using that information to come to conclusions about your company. So again, this is another issue that probably most of our engagement in Hong Kong would be around is related party transactions and the lack of information in explanatory memorandum. And just lastly, I work for a US asset manager, so I would like you all to read this slide and remember everything that's on it. So that's just an institutional investor's view of voting and engagement. And just to be clear that we can't vote with our feet on most of our investments. You are stuck with us as a long-term investor, and we'd like to get to know you. Thank you.
In our second presentation, Mr. Michael Duignan, Senior Director Corporate Finance at the Securities and Futures Commission, clarifies the FSC's role in corporate governance in Hong Kong, particularly in terms of corporate disclosure.
The principles of responsible ownership. So this is the sort of SFC's contribution to the question of governance, and as you can see, is a clear and obvious attempt to introduce an activist shareholder charter. Or at least that's what people said it was. To be honest, I look at it and I think, well, this is basically 7 perfectly sensible things that you would expect every investor to do, particularly if you're holding money on behalf of other people and you're investing it on their behalf. It's all about communication, it's all about sort of doing the right thing. It's not an activist charter, despite what you may have heard. It's about transparency, and as being a good regulator, obviously, I love transparency. And so I'll give you the benefit of the doubt and assume that you can read, so I'm not going to go through all of these things. They all seem to be, from my perspective, perfectly sensible. They're not even things that people actually have to do. People even disliked the reference to comply or explain, because comply suggested that you might have to do it, even though you can explain that you don't. So we changed it to apply or explain, which kind of sounds awfully like the same thing to me, but you know, so it seemed to make some people a little bit happier. So those are the sort of things that investors who are investing to some extent on behalf of others, we think should probably be doing anyway. So what are the objectives behind the principles? So obviously guidance to investors and to intermediaries. What's the point behind it? Establishing that sort of investment culture, and to some extent it's to encourage the sort of dialogue between investors, the owners on one hand and the company on the other, leading hopefully, ultimately, to better financial returns and market growth, which you would have thought, particularly in a place like Hong Kong, would have generated a lot of excitement, because there's nothing that people like here more than positive financial returns and market growth. So why is it important? It's partly to avoid anything that might resemble disharmony. It's always better to have a conversation with people before you get into a fight, than afterwards. And so therefore it's trying to sort of avoid the usual typical engagements, which tend to be at scheduled events, so AGM, where you're kind of presented often with a binary option. So if that's the first time that you have some sort of engagement with your investors and their reaction to what you've just asked is no, that's probably the worst time for you to find that out. You don't really want that to be the surprise. So it's developing that strong relationship between the company itself and its investors. It has slightly less resonance in Hong Kong because we do have quite a large number of companies where the family owns the company anyway, and so therefore the shareholders and the company kind of are almost one, but you have to think about the others as well. It's partly also to generate that second pair of eyes. The people who are running the company might think they know best, but if you have outside shareholders with a different perspective, they might be more international, they might have a wider understanding of a peer group, then at least if you have a conversation with them, then you get a different perspective. And it always helps to have somebody else come along and tell you that you might be doing something slightly different. Okay, this is the sort of follow-up to the other side, because as the SFC, we kind of get to play both sides. Also responsible for company disclosure. The purpose of corporate disclosure is to help shareholders to understand and to provide meaningful analysis or justification. If a company puts out an announcement that is sufficiently opaque that we cannot understand it, particularly as an inside information disclosure, clearly if you can't understand it, it's failed its entire purpose at that point. But it's a kind of a double whammy. So not only is it bad from that perspective, but you're also quite likely to get a Section 179(1)(e) notice from us, which is a statutory information gathering power, where we will ask you for really quite a lot of information that's going to spend quite a lot of time getting it together in order to supply it to us, so that we can understand what it is you actually meant by that disclosure that you made. Because from our perspective, we can't differentiate between a perfectly normal, reasonable disclosure that's just been drafted so poorly it's unintelligible, as compared to a disclosure about a transaction that was deliberately designed to be opaque, unclear, and misleading. We cannot differentiate between those two. It's only the company that knows which of the two it is. And so therefore we're likely to be sending you a 179 notice requiring you to produce lots of information to us. So if you want to avoid that, and I don't mind, I have a team of people, I'm perfectly happy to sack some of them if they're all sitting around playing cards rather than issuing these things, that's fine. They'll get paid anyway. But you really probably don't want to have that sort of engagement. You prefer not to, I suspect. One thing I thought I'd put in terms of disclosure, because it's a fairly typical disclosure, and that is the directors usually say something like, we're going to do this transaction, we're going to spend 2 billion Hong Kong. One of the conditions precedent almost always is that there's a valuation report. And the valuation report is often effectively put up as the get out of jail free card. So the company they're buying has, I'm glad you're all sitting down, a website. It's made no money, has no investments, but there's a valuation report that says it's worth 2.3 billion Hong Kong, which means that the company is getting it at a discount. And again, there's nothing that Hong Kong likes more than a bargain. It's quite clearly a bargain. So therefore, why wouldn't you buy this? Valuation reports are not a get-out-of-jail-free card. The directors still have a fiduciary duty. They still have to make the best use of the money that's available to them. So it's not a get-out-of-jail-free card. You can say, well, I've got a valuation report, therefore we don't need to really tell you anything about it because, look, I've got a valuation report. You still have to explain to people what it is you're buying and why you're buying it and what the point of it is. I think you shouldn't be focusing on what you're legally required to disclose so much as I've identified that I might have a legal obligation to disclose. So in those circumstances, what would my investors actually want to know? If you start from that perspective, you're much more likely to get to the right answer, I suspect. And it might be a sort of a bit of a borderline case. Well, it might be inside information, it might not. Actually, in those sort of circumstances, if you go to your lawyer and ask the question, am I legally obliged to disclose this? They'd probably say, well, strictly speaking, you're not absolutely obliged to disclose this in these circumstances because you have other mitigating arguments you could make, etc. If you then say, oh, great, I won't bother then, that's probably the wrong answer. I put down, except that some investors may have a different view of your prospects. I was going to mention Pax Global. In fact, I was actually showing the little YouTube clip of the analyst being thrown out of the room by Pax Global. But in some respects, actually, what I liked about Pax Global was there was more than one analyst in the room. They actually had quite a large number of analysts who were actually there. So at least they were talking to the companies, so the firms. So actually, from one perspective, they were doing a good thing at that point. Perhaps not dealing with constructive criticism in quite the way that one should, but there we go. That's what our role should be, I feel, in this area. We're there to encourage, to cajole, but to bring investors and the companies together in a sort of, mutually beneficial, harmonious relationship. I think the one difference about this, and the one thing you have to remember, is that in this case, the priest, and that is actually a real priest, has a gun. So be wary of selective disclosure. That is something that you definitely want to steer clear of. Clearly, if you're telling some people but not all people, that's going to be a problem. To be honest, in my experience, I've never had shareholders come up to me and say, I get too much information. What they usually say is, I get too much information I don't understand. That's the real problem. So I would say, if in doubt, why not disclose? What's the harm? I have no idea how much time I've got left.